Welcome students to the series of lecture on fixed income, and this is our second session in the series of lecture of fixed income. And you can also say we are starting a series of lecture within the series of lecture of fixed income because for the next 5 to 6 days we'll discuss valuation of fixed income. If you haven't watched this session yesterday or you were not the part of the session, then what we mentioned was that in fixed income we'll try to understand different types of instrument, not only fixed income instrument. Fixed income as a category of or a section in finance, it includes many different instruments like floating rate instrument, MBS, RMBS, CMBS, callable bond, puttable bond, and many other structured products. But generally in finance, we categorize all these instruments under the umbrella of fixed income. And now, to master the fixed income, as in this category of subject in fixed income, as in finance, now to master fixed income, our roadmap is super clear. We'll first understand the valuation of fixed income, right? We'll understand the valuation of fixed income, and that's why the next 5, 6 lectures will be dedicated to valuation of fixed income. And then we'll move toward interest rate dynamics, interest rate mechanics that impacts the valuation of fixed income. And then we'll discuss the interest rate sensitivity like duration, convexity. And we'll deep dive into the term structure, which is the interest rate term structure. Then we'll discuss the credit risk. And then we'll understand that how credit risk impacts the valuation. And then we'll deep dive into the products, which are not just fixed income or not just bond category products. It is the combination of derivative instruments like callable bond, puttable bond, RMBS, CMBS, ABS. So this is going to be the roadmap of our journey. And today, this is the first session on the valuation of fixed income. The first session on the valuation of fixed income. Okay. And I'll start this session with a very simple question. When you invest in any financial instrument, be it equity, be it fixed income or bonds, be it ETF, be it mutual fund, be it hedge funds, definitely you would read some documents. You will try to gauge whether the financial instrument is a value proposition or not. Is the financial instrument is is going to provide me any benefit or not? The simple question that you're going to be asking, is it a good investment or not, right? And for that, you will collect certain information for that financial instrument. If you would be reading, so for example, if you would be like investing in stock, then you would be reading what? The documents related to the stock issuance, equity issuance. If it is Facebook stock, what you will do? We'll try to understand the different parameters of that stock. What is the P ratio? What is the dividend? Right? So we'll read certain documents and find certain critical important information for your relevance that is relevant for you. And then you will decide whether you want to buy a financial instrument or not. Similarly, the question is if you're buying fixed income instrument, it is a financial instrument. If you're buying a fixed income instrument, it is a financial instrument. Then what you will do? You will definitely read certain documents. We'll try to gauge whether the financial instrument, the fixed income instrument you're investing is a good investment or not. So what you'll do, you will read certain documents and you'll try to fetch some information, fetch some data. And the document that you will read is Bond Prospectus. It is a very lengthy, hefty document, which look like this. It will have all the details about the bond, about the fixed income instrument. It would have the information related to legality. It will have the information related to issuer. It will have the information related to whether it has what kind of a seniority it has, different relevant and irrelevant information. So when you read this document, you have to extract four critical information. Four critical information. Yes. Should you read this document? The answer is yes. We all know. The answer is yes. Because we cannot gauge, is it a good investment or a bad investment? Yes. We cannot gauge without reading, without understanding, taking some data. But which data I have to look for? Should I read this plethora of documents and then decide I will do the investment? Will not do the investment. I think nobody has read ever a mutual fund document, which is a 100-page document. Nobody put so much of effort before investing. But for the valuation, the bare minimum that you have to do when you read this document, you have to extract four information about a bond. What? Four information, four bond characteristics. That's it. You have to extract the information, the data for the face value of the bond. You have to extract information which is related to the coupon of the bond. We'll talk about what is face value. We'll talk about what is coupon. You have to fetch the information about coupon frequency. And you have to fetch information about the maturity of the bond or maturity of the fixed income. Now, if I'm saying the word bond, please treat it synonymously to fixed income instrument. There's no difference. They're identical for the time being. We'll talk about the difference later. But right now, if I say bond or fixed income, please treat it synonymously. So what are the information you will extract from any bond document? See, you're not going to be a data scientist after doing FRM, but you should understand that what are the critical information that you should be looking for in your database, right? Somebody would extract this information for you when you become a financial risk manager. You don't have to do that. So you will look for face value, coupon frequency, tenure, and maturity. That's it. Why you are extracting these information? To decide whether it is a good investment or bad investment. But how? How these four information will give you the essence, the knowledge, the gyan, that whether it is a good investment or a bad investment. We'll see that. The reason is these four information will tell you what would be your future cash inflow. And that is the information for any financial instrument. When you buy a stock, what do you gauge? Okay, after 10 days, what is my cash inflow? What is my profit? If I buy mutual fund, what is my profit? What is my cash inflow? For any financial instrument, you're looking for this information. What is my future cash inflow? What I'll get from this financial instrument, that is cash inflow. Okay, so these four characteristics about the future cash inflow of the bond. These characteristics of the bond is going to tell you about the future cash inflow from this financial instrument. That's it. That's the story. Okay, so let's talk about example one. There is bond A. Now, bond A has future value, which is face value 1000, coupon 8%, coupon frequency annual, and the maturity of the tenure is 5 year. So, if the maturity is 5 year, it means that I have to think only in the tenure or the tenure of 5 year. That's it. I have to only think for the tenure of 5 year. That's it. Perfect. So this is done. I've used this information. Face value 1000. Face value 1000. Face value is always associated to the cash inflow at the maturity. That's it. Face value tells you the information of the cash inflow that you will receive at the maturity. What is the maturity? The maturity is 5 year. If the maturity is 5 year, you're gonna be receiving 1000. So you will receive what? $1,000. $1,000. When? When you will receive $1,000, you will receive $1,000 at maturity. What is maturity? Maturity is 5 year. So you will receive 1000 at maturity. 8% coupon. 8% of what? 8% of what? Coupon percentage is always associated to face value, and face value is always associated to maturity. Perfect. So coupon 8% of what? Face value. What is 8% of 1000? Anyone? 8% of 1000. What is 8% of 1000? Yeah, it's 80. So $80. $80. What I'll do with this $80? The information is you're going to receive 80 net. You're going to receive 80 net every year. Every year. Please note, for this, you don't have to look for coupon frequency. Coupon frequency is an important information. But when you look at coupon 8%, it means 8% into 1080 net every year. Okay, you will receive $80 net every year. But when? Is it in parts or is it a net payment? When I'll receive that information you will get from the coupon frequency. But in total, you're gonna be receiving $80 every year. When we don't know, for that we have to look into coupon frequency, but total will receive 80. So you'll receive 80, 80, 80, 80, 80 every year, and the maturity is 5 years, so you'll receive it for 5 times. Now, coupon frequency is annual. It means it is giving you the information when you will receive it. So you'll receive 80 net every year at the end of the year. Annual means annual refers to end of the year. That's it. So you're going to be receiving 80, 80, 80, 80, and 1080. That is your fixed cash inflow from this financial instrument. You'll receive $80 after the end of first year. Then you'll receive $80 at the end of the second year. Then you'll receive $80 at the end of the third year. You will receive $80 at the end of the fourth year, and you will receive 1,000 plus 80, 1,080 at the end of the fifth year. Cool. Now let's move to bond B, example 2. Nothing has changed because I want to keep it simple. I said face value is 1,000. So the face value is 1,000. Coupon is 8%. Coupon frequency is semi-annual. And the maturity is 5 year. What has changed? Please chat. What has changed? What has changed in example 1 and 2? Just frequency. Nothing else? Everyone agrees to this? Except frequency, nothing has changed. Because I have to teach you something important about the frequency. Face value 1,000. It is always associated to what? It is associated to what? Face value is associated to what? Maturity. Thank you. Face value is associated to what you will receive at the maturity. What is the maturity of the bond? What is the maturity of the bond? 5 year. So you'll receive 1,000 at the end of maturity of the bond. That is 5 year. Perfect. Written. 8% of 1,000 is again 80. What does this mean? What does this mean? You will receive 80. What? Please chat. No. No, don't jump. We are not talking about the frequency. We're not talking about the frequency. Don't jump. Just talk about this 80 and coupon. Coupon percentage tells you that you're going to receive 80 net every year. That's it. Net every year, you will receive 80. When? That is the information we'll get from frequency. So the frequency is semi-annual. Now it is not annual. It is semi-annual. It means you will receive 80 in two parts. Every 6 months, you will receive 40 and 40, but net you will receive 80. Is it clear? So you will receive net 80, but you will receive in two parts because the frequency says semi-annual, which means every 6 months, you're going to receive 40, 40, but net 80, then 40, then 40, then 40, 40, 40. And even at the last, you will receive 40. Is it clear? Yes, no. Everyone. This is important because if you cannot just project the cash inflow, you cannot, you cannot do the valuation. This is the foundation. Last, can you see any change in example 3? Thank you for chatting. Can you see anything in example 3? What is the change for bond C? Again, I haven't changed anything. The only thing I have changed is coupon frequency. That's all. So again, face value is 1,000. Where should I write 1,000? Please be fast now. 8% of 1,000. What does this mean? Do not look into frequency. Do not confuse yourself. 8% of 1,000. Thank you. 80 net per year. Awesome. So in total, you will receive 80 every year. But now, when is the question which will be answered by the frequency and says quarterly? So it means you will receive in how many parts? You receive it in 4 parts. So 4 parts. 80 divided by 4, 20. Awesome. Quarter. So you'll receive every quarter 20, 20, 20, 20, 20, 20, 20, so on and so forth. And even at the last, 20. If everyone is comfortable, can I give you a complex question? Please write. Please write. Face value, dollar 500, coupon, 4%, frequency, quarterly, maturity, 3 years. If you can write on pen and paper, click the photograph, send it here. Awesome. Please tell me. Please tell me what would be the cash inflow. 20 is what? Thank you. This is good. I will receive 500 at maturity. What is maturity? Okay. So what is the maturity? Maturity is 3 years. So 500 at the maturity. We are very clear with this. Perfect. Still wrong. See, 4% of 500 is what? 20. It's 20. So whatever happens on the planet. Awesome, Nitish. Very good. Whatever happens on the planet, you're going to be receiving 20 net every year. 20 net every year. But when? And is it in part? The answer is frequency. It is saying no, you will receive 20 quarterly, which means you will receive 20 in four parts every quarter. So you have to divide 20 by what? 4. You will receive 5 every quarter. So you'll receive 5, 5, 5, 5, 5, 4 times every year. And even at the maturity, you will receive 5. So you'll receive 5, 5, 5, 5, 5 every quarter till 3 year, and then you will receive 500 at the maturity. Is it clear? Do you need one more question to feel confident? Write the question. Face value $800, coupon 6%, frequency is equal to semi-annual, maturity 2 years. Tell me the cash inflow when. What should I write? See, okay. So 800 face value, it is associated with maturity. We'll close eyes and we'll write 800 at maturity. Nothing to do there, no brainer there. 6% of 800 is what? 48. Agreed? So 48 net you will receive every year. But in how many parts? Please tell me, in how many parts? 48 I'll receive in how many parts? 2 parts. So 48 will be divided by 2. You will receive 24 when? When you will receive 24? In 2 parts. Awesome. 6 months. If you have to divide 1 year into 2 parts, it is going to be 6 months, 6 months. So 24, 24, 24, 24. How many of you did this correctly? Everyone? Anyone still has the doubt? Anyone has doubt in projecting cash inflows from any fixed income instrument by looking into 4 characteristics: face value, coupon frequency, and maturity? This is what you're going to be studying throughout your sessions. Only these 4 characteristics. The game is of these 4 characteristics. That's all. Cool. If not, let's move. Perfect. Now think what we are studying. We are studying valuation. What is valuation? Valuation is the question that how much I am ready to pay today for this particular investment. What is my should be price in the market? So tell me, what do you think? Please compare these 3 bonds and tell me which bond will be priced highest in the market. Everything is identical. Face value identical, coupon is identical, maturity is identical. The only thing which is different is what? Coupon frequency. Yes, but still, I'm saying if you have a belief that all 3 bonds would be trading in the market equally, that is incorrect. And I have to build that intuition. So please tell me which one will have the highest price in the market. It is going to be bond C. I hope that that intuition is there. But now I would ask a question. Why? Why bond C? Everything is identical. Bond C will be trading in the market with the highest price. Okay. So one answer, please look very carefully. There is nothing right or wrong right now. One answer we got is more cash flow. Is actually there is more cash flow? The next answer is early cash flow. The answer is early cash flow. And the answer is definitely time value of money, but I didn't want to use the jargon of time value of money. Because we are getting the cash inflow earlier. We are receiving 80 net every year in all 3 bonds. But in one of the bond, we are receiving it earlier. So we have to respect the concept of what? Time value of money, right? We have to respect the concept of time value of money. I'm throwing a jargon for beginners, but there is a concept that if the cash flow is standing at early, then something changes. We'll see what will change. But this will lead to the discussion of valuation. So I'm asking the question again. If I have a bond or a financial instrument or a fixed income instrument, which is going to give me 80 after 1 year, 80 after 2 year, 80 after 3 year, 80 after 4 year, and 1080 after 5 years. If this is my cash inflow, the question is how much you're ready to pay today. That is valuation. But I'm actually asking the question how much you are ready to pay today. Can you solve this with a critical assumption? Please assume there is no interest rate, no inflation, no opportunity cost. Make it simple, super simple for everyone. Whether you understand time value of money or not, doesn't matter. How much? How much you're ready to pay today if there is no interest rate, if there is no inflation, if there is no opportunity cost in the market, how much you are ready to pay this? I know I'm talking about hypothetical world, but how much you are ready to pay today? Please chat any number. Let me give you the option. Less than 1400 is one option. Someone is saying 1400. Someone is saying greater than 1400. I'm repeating the question. No interest rate, no inflation, no opportunity cost. How much you are ready to pay? Three answer less than 1400. Others, please be fast. Less than 1400, less than 1400, less than 1400. Anyone other than less than 1400. Only Sahil answered 1400. Because the assumption is there is no interest rate, no inflation, no opportunity cost, the answer is 1400. That's it. We are talking about a hypothetical world. There is no interest rate, there is no inflation. Then you're ready to pay today the sum of all the cash inflow. You don't have to put down any mathematical equation here, just a simple summation. And the answer is 1400. Why? Because if there is no interest rate, there is no inflation, there is no opportunity cost, there is no concept of time value of money. The reason there is a difference between the cash flow standing today and in the future is only because of inflation, only because of interest rate, only because of opportunity cost. If there is a world, there is no interest rate, no inflation, no opportunity cost, there is no difference between the 100 standing today and the 100 standing after 1 year. So the only correct answer, the conceptual answer I got is from Sahil, that you will just do the summation. Correct. Then why anyone will invest? Very good question. But anyone will invest only because there is concept of interest rate, inflation, opportunity cost, required rate of return. And that's why people invest. And that's why people invest. And that's why the 100 standing today and 100 standing in the future have two different value in our mind. And that's why we invest. So if I ask the question that in the real world, come to the real world, no assumption about interest rate, no inflation, no opportunity cost, no assumption about anything, come to the real world. If I would have asked the question simply, can you tell me which one is more valuable, $100 standing today or $100 standing in the future? What would you answer? Come to the real world. No assumption of the interest rate. What would you answer? Which one is more valuable? $100 standing today or in future? You would say today. Everyone will say today because there is something called as inflation. There is something called as interest rate. There is something called as opportunity cost. So you got the point. The time value of money comes into the picture only if there is interest rate, only if there is inflation, only if there is opportunity cost, or any one of them. If any one of them exists in the real world, there is the concept of time value of money. What is time value of money? The time determines the value of the money. Whether the $100 standing today is valuable or the $100 standing in the future is valuable. It only comes in the picture if you have any one of the component. So in valuation, only cash inflow is not important. What is important? Important is interest rate. Important is inflation. Important is opportunity cost. I'm saying you all are right to answer less than 1400. You all are right if you have interest rate in the world, if you have inflation in the world, or if you have opportunity cost in the world. Be very clear about that. But I ask the question if there's no interest, no inflation, no opportunity cost. That is a very thematic intuition. Otherwise, you will not understand the valuation. You're not crystal clear about time value of money. And therefore, in the next session, we have to deep dive into the concept of time value of money. And we'll invest some time in discounting and compounding. What is discounting and compounding? Just let me build the intuition and I'll pause the session for today. If I say $100 standing is $100, then today, what is the value of this $100? What is the value of this $100? You all said $100 standing today is more valuable. So can you tell me then what is the value of this $100 today? Is it 90? Is it 95? Is it 92? Is it 93? Give me a number. Give me any number. Everyone, please say the number. I want to tell you something. Jyoti said 90. Next. It's correct. Next. 94. Correct. Next. 80, even if this is correct. 95, 95. See, whatever the number you are saying, whatever the numbers you're saying, that is in your head, right? And whenever that consensus happened, whenever the whole crowd think about the number, if you take the average of all those numbers, that is the number actually. And that is reality, that is going to be the interest rate. The back calculation is going to give me the interest rate, because this is all the game of supply and demand. When you're saying 80, when you're saying 90, when you say 95, when you say 95, you're actually throwing your demand of the 100 standing in the future. And when you sum this all and take an average, that is going to be the number. So today we just understood that how to take out the cash inflow. Tomorrow we'll try to do the real valuation, but I need something important, that is BA2 plus calculator. With that, I'll pause here. Thank you. Have a nice day.